For many homeowners, the monthly housing payment can rise for more than one reason. It can rise because of the mortgage. It can rise because of property taxes. And increasingly, it can rise because of insurance. This is one of the hidden housing costs many households do not see clearly until a renewal notice arrives, or an escrow payment changes. Homeowners insurance is becoming a larger pressure point in the American housing budget. It does not only affect people buying new homes. It can affect people who already own a home, people with fixed mortgage rates, landlords who own apartment buildings, and renters who may eventually see part of those costs reflected in rent. The pattern in the verified data is clear. Insurance premiums have risen sharply. Availability has become more difficult in some high-risk areas. Some insurers have reduced coverage or stopped writing new policies in certain markets. More households are being pushed toward state-backed or last-resort insurance options. The result is a housing cost that can increase even when the mortgage rate has not changed. That is why this issue matters for middle-class households. A family may believe it has locked in its housing cost with a fixed-rate mortgage. But if the homeowner's insurance premium rises, the total monthly payment can still increase through escrow. For renters, the connection is less direct, but it still exists. Apartment building owners also pay property insurance. When that cost rises, some of it may move into rents. LFLOUGH research shows property owners absorb much of the pressure themselves. This is not a story about one insurance company. It is a story about a system. Weather risk and rebuilding risk affect insurer losses. Insurers buy reinsurance to protect themselves from large losses. Rebuilding costs and labor costs influence how expensive claims become. State regulators decide how much rates can rise and under what conditions. Mortgage lenders often require insurance coverage. Households then face the costs through premiums, escrow payments, or rental pressure. The chain is straightforward. Higher expected losses and rebuilding costs put pressure on insurers. Insurers seek higher premiums, reduce exposure, or decline to renew some policies. Homeowners face higher annual insurance bills. Mortgage escrow payments can rise. Landlords face higher operating costs. And households feel the pressure inside their monthly budgets. On January 16, 2025, the U.S. Treasury's Federal Insurance Office released a major report on homeowners' insurance markets. The report used data from 2018 through 2022. Treasury found that homeowners' insurance costs were rising and that availability was declining, especially in areas with high expected climate-related losses. That finding matters because the issue is not only about price, it is also about access. In the highest-risk zip codes, homeowners paid much more than homeowners in the lowest-risk zip codes. Treasury data showed that homeowners in the highest 20% of zip codes by expected climate-related building losses paid an average premium of $2,321. That was 82% more than homeowners in the lowest-risk zip codes. For a household, that is not just a risk score. It is a real bill. It is money that cannot be used for groceries, utilities, transportation, medical expenses, credit card payments, savings, or repairs. The same Treasury research found that consumers in the highest-risk zip codes faced average non-renewal rates about 80%, higher than those in the lowest-risk zip codes. That means some homeowners are not only paying more, they may also have fewer choices. When a policy is not renewed, a homeowner has to find replacement coverage. In some areas, that may mean fewer private market options, higher premiums, different coverage terms, or a last-resort insurance plan. Treasury also found that claims were larger in the highest-risk areas. Average claims were about $24,000 in the highest-risk zip codes, compared with about $19,000 in the lowest-risk areas. That helps explain part of the pressure inside the insurance market. Insurance companies price policies based on the possibility of future losses. If claims become more frequent or more expensive, premiums can rise. If insurers believe the risk is too concentrated, they may reduce exposure in certain locations. Climate risk is not the only factor. Rising rebuilding and repair costs also matter. When building materials and labor become more expensive, repairing or rebuilding a damaged home costs more. That can increase claim costs, and higher claim costs can affect future premiums. Reinsurance costs also matter. Reinsurance is insurance for insurance companies. Insurers buy it to protect themselves from large losses, including wildfire, hurricane, or severe storm losses. When reinsurance becomes more expensive, insurers may seek higher premiums from homeowners, reduce the number of policies they write, or pull back from markets they consider too risky. This is why a household insurance bill is connected to a much larger financial system. A homeowner may see only one renewal notice. Behind that notice are claim models, disaster risk, rebuilding costs, reinsurance contracts, state rate approvals, and insurer decisions about where they are willing to do business. On April 1, 2025, the Consumer Federation of America reported that typical U.S. homeowners saw insurance premiums rise by an average of 24% from 2021 to 2024. According to the organization, that increase was twice as fast as inflation. CFA estimated that the typical annual homeowner's insurance premium increased by $648 over that period, reaching $3,303 per year in 2024. For a household, $648 per year is not only an insurance statistic, it is roughly $54 per month in additional pressure. That increase may arrive through a renewal bill, or it may arrive through an escrow adjustment. Either way, it becomes part of the housing payment. The same CFA report estimated that premium increases created a $21 billion additional annual burden for homeowners buying the most common coverage. When renters, condo owners, manufactured homeowners, and other coverage types are included, the estimated additional annual payments reached $27 billion. These figures come from a consumer advocacy research report, not an official government dataset. They should be identified carefully. But they show how insurance pressure can add up across millions of households. The pressure is also geographically uneven. CFA reported that premiums increased in 95% of U.S. zip codes from 2021 to 2024. Consumers in one-third of zip codes saw premiums rise by more than 30%. The largest increases in that report were not limited to the most obvious coastal markets. CFA identified a 59% increase in Utah, a 50% increase in Illinois, a 48% increase in Arizona, and a 44% increase in Pennsylvania. That matters because homeowners' insurance pressure is often described as a coastal issue or as a problem limited to wildfire and hurricane zones. The verified data suggests a broader pattern. High-risk areas face the sharpest affordability and availability problems. But premium pressure has appeared across many states and zip codes. California shows one side of the issue, availability. AP reported that major insurers, including State Farm and Allstate, had stopped writing new policies in California because of concerns about losses from wildfires and other natural disasters. AP also reported that California's FAIR Plan, the insurer of last resort, more than doubled between 2020 and 2024, reaching nearly 452,000 policies. A last resort plan can provide coverage when private insurance is difficult to find. But it is also a signal that more households are having trouble getting standard coverage in the private market. In March 2024, State Farm announced it would discontinue coverage for 72,000 California houses and apartments, according to AP reporting. For affected households, a non-renewal is not just paperwork. It can create uncertainty and urgency. Homeowners may need to find new coverage quickly, compare higher premiums, accept different coverage terms, or turn to a last resort plan. California has also tried to change the rules of the market. AP reported that a California regulation announced in December 2024 requires insurers to increase high-risk area coverage by 5% every 2 years until a target is reached. Insurers must eventually write high-risk area coverage, equivalent to 85% of their statewide market share, to keep doing business in the state. The goal is to improve availability in areas vulnerable to wildfire and climate risk. There are competing views on that approach. California Insurance Commissioner Ricardo Lara said Californians deserve a reliable insurance market that does not retreat from communities most vulnerable to wildfires and climate change. Consumer advocates were more skeptical. Jamie Court, president of Consumer Watchdog, criticized the plan as being of the insurance industry, by the insurance industry, and for the industry. AP also reported that critics warned premiums could rise by up to 40% if reinsurance costs are allowed into rates, but the state did not provide a cost analysis of the potential consumer impact. That means the policy should be described carefully. It may improve availability. It may also create affordability concerns. The verified evidence does not support a simple conclusion that it will definitely lower premiums or definitely raise them. North Carolina shows another side of the issue: rate increases through regulation. AP reported that homeowners' insurance base rates in North Carolina will increase by an average of about 15% by mid-2026. The increase follows a settlement between regulators and the insurance industry after a much larger requested increase. The North Carolina Rate Bureau had requested a 42.2% average increase in January 2024. The settlement instead allowed two phased increases of 7.5%, one beginning June 1, 2025, and another beginning June 1, 2026. North Carolina Insurance Commissioner Mike Causey said the proposed rate increases were sufficient to make sure insurance companies, after paying large sums due to natural disasters and facing increasing reinsurance costs, had adequate funds on hand to pay claims. This is the regulator's challenge. If rates are held too low, insurers may argue that they cannot cover losses and may reduce availability. If rates rise too quickly, households face affordability pressure. Regulators are trying to balance consumer protection, insurer solvency, and market availability. For homeowners, that balance is personal. A 15% average base rate increase is not just a regulatory outcome. It can become a higher premium. A higher premium can become a higher escrow payment. A higher escrow payment can become a tighter monthly budget. The renter connection is also important, but it has to be explained carefully. Renters do not usually pay homeowners insurance directly, but apartment building owners pay property insurance as part of their operating costs. When those costs increase, some of the pressure can move into rents. Federal Reserve research published on September 19, 2025, found that multifamily property insurance costs increased sharply from 2019 to 2024. The cost rose from $39 to $68 per apartment unit per month in real terms. That is an increase of more than 75%. The same research estimated that rents paid by the average apartment tenant rose by $7 to $12 per month because of increased property insurance costs since 2019. That is real pass-through, but it is not full pass-through. The Federal Reserve researchers also found that a $1 increase in property insurance costs reduces apartment owners' net income by about 72 cents. That suggests owners absorb much of the pressure themselves. So the renter story is not that insurance costs automatically become rent increases dollar for dollar. The more accurate point is that insurance costs are adding pressure to rental housing economics. Some of that pressure appears to reach tenants. Much of it appears to reduce owner income. Over time, it may influence rents, building finances, and investment decisions. This is why homeowners insurance has become part of the broader housing cost story. For years, many households focused on mortgage rates, home prices, and rents. Those remain central. But insurance is now a growing line item inside the cost of housing. For a homeowner with a fixed-rate mortgage, the principal and interest payment may be stable. But the escrow account can change. Insurance premiums can rise. Property taxes can rise. The total payment can increase even when the loan itself has not changed. For a renter, the connection is less visible. Rent may reflect many factors: the owner's financing costs, maintenance, taxes, insurance, utilities, local supply, and market demand. Insurance is only one part of that system. But in many markets, it is becoming a more important part. For retirees and fixed-income households, premium increases can be especially difficult. A home may be paid off or the mortgage may be manageable, but insurance is still needed to protect the property. If premiums rise quickly, the household may have fewer ways to absorb the increase. That specific retiree impact requires more targeted data before making strong claims. But as a household budget mechanism, the pressure is clear. Unnecessary cost rises and fixed income gives the household less flexibility. The broader pattern is not a nationwide insurance collapse. That would go beyond the evidence. The verified evidence supports a more specific conclusion. Homeowners' insurance costs are rising. Availability problems are concentrated in higher-risk areas. Last resort plans are growing in some markets. Premium pressure has spread across many zip codes. Renters may see some indirect effects. Regulators are trying to balance affordability with keeping insurers in the market. The current status remains uncertain in several important ways. Treasury's national report is based on data from 2018 through 2022. It gives a strong structural picture, but not the full market stress that developed after 2022. CFA's 2021 through 2024 analysis suggests that premium pressure continued after the Treasury period. Federal Reserve research shows that multifamily insurance costs rose sharply through 2024, AP reporting shows. State-level developments in California and North Carolina. The next phase remains open. Premiums may continue to rise in some markets. Insurers may return to some areas if regulations change. Last resort plans may keep growing. Reinsurance costs may shift after future wildfire, hurricane, and severe storm seasons. Rent pass-through may change depending on local housing markets. Mortgage stress may become more visible in places where insurance increases are steep. For households, the pressure chain is clear. It begins with risk, rebuilding costs, claims, and reinsurance. It moves through insurer pricing and state regulation. It reaches homeowners through premiums and escrow. It reaches renters through the operating costs of apartment buildings. And it reaches the middle-class budget as one more line item competing with groceries, utilities, transportation, medical costs, credit cards, and savings. The story is not that every homeowner faces the same increase. They do not. The story is not that climate change alone explains every premium increase. It does not. The story is not that renters are paying every dollar of higher property insurance costs. The research does not show that. The story is that insurance has become a more important and less predictable part of housing affordability. For households in high-risk zip codes, the issue can be price and availability at the same time. For homeowners in other states, it may be a renewal notice rising faster than expected. For renters, it may be another cost pressure behind the rent. For apartment owners and small landlords, it may be higher operating costs and lower net income. This is how a complex financial system becomes a household issue. A premium increase may begin with an insurance model, a weather risk, a reinsurance contract, or a state rate filing, but it ends in a household budget. A family may not follow every insurance regulation. It may not know the details of reinsurance markets or claim severity. It may only see that the monthly payment is higher, the renewal is harder to afford, or the available options are fewer. That is why homeowners insurance is becoming the hidden housing cost. It is not always visible at first. But when the premium rises, when the escrow account resets, when a policy is not renewed, or when rental operating costs increase, the pressure becomes real. The current reality is that insurance is no longer a background expense for many households. It is becoming part of the broader cost of living story. What remains uncertain is how far premiums will rise, how much availability will improve or worsen, how much renters will ultimately absorb, and whether state reforms can keep insurance markets functioning without putting too much pressure on household budgets. For ordinary Americans, the concern is straightforward. Housing affordability is not only about the price of the house. It is not only about the rent. It is not only about the mortgage rate. It is also about the hidden costs attached to keeping a home insured. And as those costs rise, the pressure can move quietly from the insurance market into the monthly budget.